It's been a tough few weeks for the Ape Nation and Wall Street Bets. AMC and GME haven't been going in the direction, and especially with AMC, there's a lot more pain, especially a little bit of a drop off today, where those that are trying to hold are feeling some pain there. So what I'm going to share with you in this video are AMC and GME, what I'm seeing, and technically, if you follow charts, what it's not showing is bullish, but to understand what you're seeing and understand the other side of the game, and to understand how to better position against situations like this, where you can at least reduce your cost that has on that position. So if you bought shares, how to reduce that cost so you can hold longer to reduce on the downside, and also how to strategically get back in or add to that position through the options market. So we're going to take a look here at AMC, and right now for AMC, it's not looking that ideal. Now, listen, I know Ape Nation's going to come at me and tell me, nope, it's going to go to the moon. That's great. We got to worry about right now. We got to worry about right now how to protect that money. And if you think it is going to go to the moon, it ain't going to happen just in 1 day or 2 days. It's going to take time, and you have to be strategic and manage that risk over time. So we're going to talk about building a core position. Would be a core position being one position, how to trade around that position. And really, you want to stick it to Wall Street, you want to stick it to them, you have to understand the game. They have OPM, other people's money. You have your own money. You got to be strategic. That's the disadvantage. But listen on how to do this. And Ape Nation, Wall Street Bets, you could stick it to them. So let's look at the AMC here again. And on the AMC here, right now, anybody that tries to chart this is, if you're trying to chart this, it's kind of silly because right now it's just all volatility. This is just volatility. There's not a lot of price discovery because of that squeeze that happened and forced buying and so forth that's caused all this. So that's why you see the big pops and then it settles down and then it pops again. Right now it's rolling over, and yes, it could, and it's retraced this whole move, almost about to retrace this whole move here. But again, we could see that pop. The difference on this one I talked about before on AMC, it's a hard to borrow, meaning that there's shares still to borrow. When we look at GME is a hard to borrow. Well, actually, hard to borrow and AMC. Okay, so GME actually, so this has changed over last week. GME was a none to borrow, specifically here with, well, now it's Charles Schwab. But this was a none to borrow, so it's changed. Now what that means is if it went from none to borrow to hard to borrow, meaning that there was nothing to borrow, now there's still some places you can borrow, it's just harder to find. So that's a big change that changes where people can actually lay into shorts. Now what happens is that when short sellers look at this kind of stuff, this is not even based on fundamentals, this is just based off of exhaustion of the buying. So when we look here, this is just considered a triple top here. This is not ideal. And then when you start to see it roll over, that's where shorts start to pile in. When we look at AMC, AMC is the same thing as well. This is where they would start to, this would be considered a rounded top, which is bearish. And you can see it, that's why it falls. Now we could get a lift up higher, but once that lift happens, how short sellers are going to play this is they're going to pile onto it. Some of them are going to be a little bit more cautious because they don't want to get caught on the other side of the trade, meaning get their face ripped off. So they'll start to cover at these levels, and I imagine that we saw some covering today as well. So they were covering in there. They'll wait for a little bit of a push higher, and they'll start to cover again. So that's where the battle happens. That's where price discovery happens as well. Now, if you have a position, now I know a lot of you are owning shares. If you own shares, what you ideally want to do is when there's times of, specifically GME is the best example because this has happened. This is 6 months, a time frame we can look at in our best case example here. So even after it pulls back, comes all the way back, just because that whole issue that happened with restrictions, we get a big push back higher, and it kind of comes back here, and we get this rounded bottom, which then pushes all the way back here. Well, this rounded bottom is a time frame that is can take a while. In this time frame, and this is how typically prices will react. You get the pops, you get this, kind of the dust settles, and you get the momentum again. Stocks either go higher, lower, or sideways. Most of the time, sideways or in a range. So what you ideally want to do is you want to sell calls against it. Yes, I know it ain't the thing that you want to do, but if you understand how you could push that squeeze, that would be a way. You can, if you owned, let's say, 500 shares, you don't have to sell. If you sold calls, you could sell some. You could sell 3 calls against your position of 500 because one option is worth 100 contracts, or I mean, worth 100 shares. So one contract is worth 100 shares. You sell 3, and you still have 200 shares that are uncovered. So you don't have to do a full covered position, but you can do it like that. So what I would be doing here, if I own this position, is I'd be selling calls. I'd be selling calls against it to reduce my cost basis to get more money coming in, where I can use that money to then buy shares to refill the tank. So if I bought shares at $100 and I keep selling $10 calls, that chips away and they expire worthless. That's reducing. If I had shares at $100, sold calls at $10. That's the kind of premiums that you're getting here, because we just look at GME for the next 30 days. They're pricing in $62, higher or lower. That's the expected move right now. It's higher or lower, $62. I mean, that's a crazy move. That's not almost. That's $65. So 65, about 120 to 250. So that's a pretty wide range. And if you look here, that's, right now it's you can almost consider this mid-range here. I mean, when we look at that. So where we would do that is that we would reduce that cost to $90 if that were the case. And you keep selling them, reducing your cost, which benefits you, because if you get your cost to 0, you own them for nothing. That's the game. That's the game you want to play. Because if you own them from nothing, then it can go to the moon. So you want to reduce that cost as much as you possibly can. And if you choose to, it's not the smartest thing. And I'm not a financial advisor. This is not financial advice. This is just generic, what if, how could we do this, education. AMC, same thing. Now on AMC, as we said, this is a little bit different, because what we could look to do is on a dip, you don't want to get long when momentum's higher. I mean, a lot of people, this is where they're getting burned. They're buying into that momentum. You want to be positioned before that pop higher. This one, if you're looking for this to pan out the same way as GME did, and this is going to squeeze again, if that's the case, then you want to buy when the sellers are getting a little bit more aggressive, which it would be right now. So when they're trying to cover their position, this is almost forced buying as well. You want to be buying in that position as well, which forces prices to go higher. That puts a floor in, that puts a bid in, and that starts to create almost a powerful momentum move higher, which then those who are opposite of this position start to see that momentum push through there. They get scared because they think, oh my God, it's going to happen again, and that's forced buying. And that, is what could happen. So the best way to do that is to sell puts to get your position. Now, there's a lot of risk that goes involved with this. So this is just very generic, but this is how you would trade around a core position. How to build it, how to manage it if you're looking long term. And this is the benefit of doing it yourself. You take the time, you can understand this kind of stuff and be able to do that. So we just looked at AMC, and we sold the $43 put today. I mean, we could get $8 for that. $8. Now, I know it's not, holding the share, but it's also putting a bid in the floor as well. You're helping your counterparts. But let's just say you took this at $8 and you were put shares. So let's say you got put shares at $43. You took in $8. So your cost basis on this is $8 minus 43. So we're looking at $37. So you would own shares at $37 with that being aggressive, and this is where you would be at. You would be at this bottom here. So it's a little bit more strategic way of getting involved and getting positioning in there. Now, if you didn't get put shares, then you could, at the same time, just take in that $8 and you see shares go higher. So if you had a position, uncovered shares, had a stock, and you sold, you wanted to add to it and you weren't able to, but you were collecting premium, that's still reduces your overall position. So maybe it pops higher again and it comes back down. You do it again. You know, if you're going to play this to the moon, this is going to take some time. So this is how you build a core position. This is how you would trade around and go back and forth. So that's the exciting thing about using derivatives and using equity. Trading stock is easy. Start playing with the options, it starts to get a little messy. That's why it's not really ideal just to buy the calls, because they can expire, they can decay. If you have the position, sell the calls. Give the calls to someone else. Let them buy it. You take it. You take in that. You continue to hold that position, and you continue to battle with Wall Street and the hedge funds. So that's the game. That's what you'll be looking at. That's how you play it. You reduce your cost basis, and you're looking to get that cost basis if you own shares all the way down to zero or as low as you possibly can. So that's what I have for you today. Let me know what you think. Yeah, I know. I mean, we're going to play it to the moon. I know. But let me see if you learned a few things here. I know it's a little bit different than what some other people are putting out there, but this is the most strategic way to play. Not to play, yeah, it's a strategic way to still win what you're trying to do or play the game that you're trying to play, which is to squeeze the hell out of them. So I'm all for it. But there's a way to do it, to be smart and savvy. This is a smart and savvy way to do that. So let me know in the video, or let me know in the comments below here. Make sure you like the comment. Hey, if you liked it, please share. Let me know what you thought. If you have questions, also put them below as well. We'll see you in the next one.